many educations, many courses like this, and he knows what he's saying. He's incredibly competent, and he is not backed up. He's not rushing you through very complicated information. He explains it really well.
I'm Jacqueline Cox Anderson from Aquila Real Estate Inc., brokerage in San Diego County. The course was worth every second of the drive to Orange County. Thank you.
It was a wonderful course, and I got so much more out of it than I even expected.
This was a great seminar. It was very informative. Although some of us have been in the business a long time, but we still found that there was a lot of information that we were not familiar with. And Paul did a great job of explaining it to us. He broke it down to us in layman terms, and we will be inviting him back.
When it comes to this material, Paul knows this stuff bar none better than anyone I've ever talked to. I've been in this field for 5 years, and he's helped me personally as well as many of my clients, and I suggest you give him the opportunity to do the same for you.
Very informative, very educational, and if you didn't make it here, you need to make the next one, because there isn't a realtor out there that shouldn't be here learning this information.
And that I really don't have an introduction for, because he is just all around awesome. It's Attorney Paul Horn. Give him a great hand, please.
All right. Can you all hear me out there? Yeah. Can you all hear me okay? Yeah? Yeah, okay. So look, I'm videotaping this session. There's 2 cameramen here, so just sort of, if you can't see something, we'll figure out later, but I'm going to use the PowerPoint. That's going to be the PowerPoint you're going to be seeing there, okay? I'll go slowly. Take note. I promise you, something I'm going to say, you're going to be able to use in your business, okay? Take note. I'm going to go fairly fast. I'm not taking any question for the first 90 minutes, okay? So just take good notes. I promise you, everything that I say, you should be thinking to yourself, how do I use this from a marketing point of view? How do I use this to help the homeowner? Okay, always ask yourself the question. Ask yourself that question as I'm going through this. So, no question for the first 90 minutes. After 90 minutes, then I'll open up for questions. So can everybody sort of adjust yourself a little bit, okay? I'll be on the stage here. You'll see me. You'll hear me talk. If you can see the screen, that's good. But if you can't see, don't. Just bear with us for a minute, okay? Just take good notes. All right. So let me. All right. So let's start. My name is Paul Horn. I'm a California attorney. I'm also a CPA. Okay. What we're going to talk about today is you as a real estate professional. When you come across a homeowner, let's say who cannot pay their mortgage, they're going to be wondering what should they do, right? Should they short sell their house? Should they file bankruptcy? Should they do loan mod? What should they do? So now that portion is just a distressed homeowner portion. There's going to be a handful of people who are current with their mortgage, but who are so upside down with their mortgage, right? They owe $500,000 on their mortgage. Their next door neighbor just sold their house for $300,000. Okay? Those individuals might say, hey, I'm not in trouble at all. I'm not in trouble, but what are my options? I have the subprime mortgage that the bank won't let me out. What are their options? So pay attention. This session is not just for distressed homeowners. It's not just for short sale, okay? Everything that I say here, if you learn it, you're going to be able to talk to essentially every single homeowner, okay? So I'm going to get started with the slides. So look, nationwide, since the housing crisis, nationwide, we have about 3.8 million foreclosed homes. There's another 5.6 million to go. There's about 5.6 million distressed homeowners nationwide, okay? If we drill that down, right now we're videotaping in Southern California. So if we look at the individual county, for example, in Riverside County, we have about 142,000 distressed homeowners. Distressed homeowners, 142,000. But below that, in addition to that, we also have another 185,000 distressed homeowners, upside down homeowners, okay? So San Diego County's got 119 distressed homeowners. Orange County's got another 109,000 distressed homeowners, meaning in foreclosure. Los Angeles got another 345,000. If you just add up all the distressed homeowners in foreclosure, that's about 745,000 distressed homeowners. That's not counting underwater value home. Okay, so remember, everything I say today is not necessarily has to do with short sale. It's people that says, I'm current, I'm doing great, but is there an option for me? Today, I'm not going to make you an expert as an attorney. I'm not going to make you an expert at anything I talked about. It's for you to sort of see the forest, to navigate, okay? The whole goal is when you meet a homeowner, you should be able to have an intelligent dialogue, just to say, hey, here are the things out there. Not to become an expert, but just a general idea, okay? All right, so today, this is going to be our course outline today, okay? This is the 5 things we're going to touch on. The first I'm going to touch on is government program. There are a ton of government programs developed to help homeowner keep the house. It's a home retention program. There's a whole bunch of them now. When you listen to this, 2 things going to happen. You're going to be able to help the homeowner. At the same time, some of this may apply to your friends and family or yourself. Okay? So this is not just for your clients. All right? Then I'm going to talk about the national mortgage settlement, where the bank was essentially fined, was sued by the federal government, and they said, here, we'll give back $25 billion to homeowners in various forms. We're going to talk about it. We're going to talk about who qualifies, who doesn't qualify. And then we're going to move on a little bit closer to home. We're going to move down to the California Homeowner Bill of Rights. Okay? It's a big deal, California Homeowner Bill of Rights, because foreclosure dropped by 62% this year in January. Huge drop. Why? Because California Homeowner Bill of Rights has built-in breaks and procedures to stop foreclosure. You need to learn about it, okay? And then we're going to talk about California short sale law. We're going to talk about tax law, and we're going to get a little bit into the tenants law, okay? All right. So from here on out, I'm going to go fast. Take note. Take as much as you can. I promise you everything I say, you can use it in some form of marketing form to help the homeowner, okay? So let me start. So the first thing I sort of want to address is this. As real estate agents, you, professional real estate agents, are really the front line. You are the one that gets in touch with the homeowner. And why do I mention that? Because you are the only one that has some sort of fiduciary duty towards your client. Do you think the bank care? I don't think so. The bank don't have that form of relationship with your client. They don't have a fiduciary duty to your client, okay? If they foreclose on your clients owe $150,000, they don't care. Your job is a little bit different. That makes you so special because you have the homeowner's best interest in mind, right? That is in the code of ethics, right? When you became a real estate agent, that's part of the fiduciary duty that you have. So I wanted to point that out. I think that's very important, okay? So let's go. I'm going to talk about, let's start with when we talk about national contractual program, this is where it's not law, but it's essentially business obligation that the bank, that the mortgage company has to give to your homeowner. These are contractual programs. These are not law. When we talk about HAMP, a loan modification, it's not the law, but it's the business obligation that the bank says, hey, okay, we took some TARP money, we agreed to sign up to help the homeowner, okay? So when we talk about HAMP, making home more affordable, we're going to get into some loan modification stuff, okay? I want you to understand all these programs from a forest standpoint, okay? So to navigate it. I don't want to make you an expert. The reason why I'm teaching you some government program, some loan modification program is because your potential short sale candidate, they may want to discuss loan modification, right? You need sort of just a rough draft, what to say, where to go with this, okay? Remember, I'm here today all of you here today is to protect the homeowner. And believe me, if you protect them, it's also in your best interest also. You're gonna make money. At the same time, you're gonna help the economy as well. Why? Because you're gonna prevent foreclosure. If someone cannot keep their home, you should do a short sale for them. Foreclosure hurts everybody, okay? Let's face it. Foreclosure hurts the economy, foreclosure hurts the value of the houses, so it's good for everybody, okay? So, rough draft, I'm gonna talk about HAMP. HAMP is what most loan modifications are at. We're gonna talk about the PRA. The PRA is a separate HAMP program. It's a principal reduction program. It's a federal program. We're gonna talk about 2MP, second lien modification. The majority of homeowners, some homeowner gets their first loan modified. What about the second loan? What about the horrible interest rate on the second loan? What did they do about the second loan, okay? And then we're gonna talk about FHA HAMP. We're gonna talk about FHA has their own second lien program. VA has it also. We're gonna talk about unemployment. If you're unemployed, you don't qualify for loan modification, but there's a federal government program for you that's going to suspend your mortgage for 12 months. You see that? Are you beginning to get this? Hey, you're unemployed. Did you know that the federal government will suspend your mortgage for 12 months? Let me show you. Doesn't that make you a much more powerful realtor? Okay? These are some of the stuff I want you to start questioning and use in your marketing material. Okay? Lee Harnish program is going to deliver you in front of the homeowner. What are you going to say? You're going to say what I'm going to say. Okay? These are the stuff you're going to say. All right? And then we're going to talk about the neighborhood. It's the HUD program. There's a huge fund that's out there to help neighborhood in distress. Have you heard of Keep Your Home California? What is that all about? Okay, well, that's part of the hardest hit fund. $7.6 billion given out to 18 states. California is one of them. California got $2 billion out of the $7.6 billion. Okay, $2 billion. You heard commercial out there. Why are they publicizing this? Because only $500 million has been used. Only $500 million. There's a lot of money left. Okay, Keep Your Home California is a big deal. You need to know about it. Okay, we're going to get into refinance. HARP, great program. HARP is a great program. Most Fannie Mae, Freddie Mac, if they haven't refinanced their loan, they should take advantage of the low interest rate out there. We're going to talk about FHA short refinance. We're going to talk about VA. If someone's a VA, they need to know about the program we're going to talk about. We're going to get into, now, a homeowner is going to do all the above, loan modification, refinance. If it doesn't work, is there a federal program for transitioning out of their house, AKA a short sale, right? Federal program, HAFA. We're going to talk about HAFA a little bit. Okay, so let's get started. Let's talk about some core concept. Let's talk about some core concept of a loan modification, okay? A loan modification is the same loan. It's the same loan with better terms. Now, in a loan modification, the goal is to lower your monthly payment, right? Your payment is too high, you're in foreclosure, a loan modification will lower your monthly payment. So for a loan modification, you got to have a job. You got to have a job or some source of continuing income, okay, for a loan modification. Now, there are 4 ways. There are 4 ways how a loan modification is effectuated. One way is they lower your interest rate. That's the common way, right? One way is they lower your interest rate. Interest rate normally starts at 2%, maybe for 5 years, then it goes to 3%, 4%, maybe stay fixed at 4%. So they lower interest rate, that's one way. The second way is they extend the life of the loan. Instead of having a 30-year loan, now it's 40-year loan, okay? To make a payment lower. The next way they do a loan mod is maybe have some principal forbearance, where let's say you owe $800,000, maybe they take $200 of it and put it aside. They don't charge you interest. That's called a forbearance, okay? And then the fourth way is not done a lot, but the fourth way is straight up principal reduction. So loan modification, guys, is a combination of these 4 things, right? Interest rate, they lower it. Or 2, they extend the life of your loan. Or 3, they take a portion of your principal balance and a forbearance, or number 4, principal reduction. Okay, these are the only 4 ways that a loan modification is done. Okay. So of course, in a loan modification, you got to have some hardship. You got to have a hardship. Okay. So most loan modification is going to start with a trial offer. Okay, it's going to start with a trial offer. How it works is this: I just have a friend in Riverside who owes $1 million on his house. 3-month trial offer. Boom, he gets a loan mod, principal reduction down to $500,000. So it normally starts with a trial offer, 3 months. Next. So now I understand as I'm explaining loan mod to you, right? You're probably wondering, well, how do I make money from this? Well, one way that you can get involved is help the homeowner maybe assemble the loan modification package, right? All you got to do is, hey, inventory is so tight. Everybody's fighting for short sale, fighting for listing, right? Let's add value, right? Because homeowners don't understand that, hey, there's a package to be filled out. All you got to go is go to the servicer's website, print out the loan modification package, and help them assemble it, right? Because once the loan mod fails, guess what? You're their friend, right? Keep in touch. Okay? All right. Now, one thing I do want to sort of let you know is in a loan modification, California doesn't allow any upfront fee. Okay, so be careful. Tell your homeowner, tell your friends to watch out for foreclosure scam. Okay, so now let's talk about how do you qualify for a HAMP? How do you qualify for this federal loan modification? Well, number one, so remember this date. Remember this date, January 1st, 2009. That date's going to come up. Your loan has got to be before. It's got to be before January 1st, 2009. It's got to originate before 2009. And your first mortgage has got to be below $729,000. So remember the date, January 1st, 2009. Remember the following loan balance I'm going to tell you because they repeat themselves in other programs as well. Okay. So for a single resident, 1 unit is $729,000. For 2 units is $934,000. For 3 units is $1.1 million. For 4 units is $1.4 million. These numbers and date repeats themselves in all the other programs we're going to talk about. Okay? All right. So of course, to get a loan modification, you got to have some sort of hardship. All right. You got to submit in financial documentation. Hey, homeowners, if you want a loan mod, you got to give me a W-2s, tax return, the whole 9 yards, financial documentation. Okay? For a loan mod, if you've been convicted of a felony in the last 10 years in relation to a mortgage or real estate transaction, you don't qualify. So that's a 10-year ban if you committed some sort of felony. Okay? All right. So if your homeowner, so after you go through this checklist that I just talked about, if your homeowner qualifies, then just call the servicer, call the bank, and direct them to talk to the bank. Okay? So which lender participate in HAMP, the loan modification? Well, there's about 100 plus lender and servicer. If you go to my website, Paul Horn Law Firm, there's going to be a tab, resource tab, paulhornlawfirm.com. That's going to be a resource tab. You go to that tab. I have the 100 plus servicer there for you. Okay? All right, so that's the HAMP eligibility. I'm going to move on to the next program. Now, I'm leaving the HAMP program now. I'm leaving the HAMP program. I'm going to talk about PRA. PRA is a separate program. It's called the Principal Reduction Alternative. This is just a flat-out principal reduction. Okay, it's a different program than HAMP. So now PRA is offered by the same 100 or so plus servicer that participate in HAMP, also participate in this separate program called a PRA. Okay. So it's offered by the same 100 plus servicer. Now let's look at the eligibility. The loan, your loan, to qualify for the PRA, Principal Reduction Alternative, cannot be a Fannie Mae or Freddie Mac loan. It cannot be a Fannie Mae, Freddie Mac loan. You have to be underwater. You have to owe more on the property than the value is worth. It's got to be your primary resident. Let me repeat that. The PRA, Principal Reduction, it's got to be your primary resident. HAMP, the one I talked about earlier, the loan modification, I never said anything about primary or rental, right? Even a rental property too, guys, is going to qualify for a loan modification now. Okay, so very, very important, okay? Someone has 3 houses, the 2 houses are rental, they're trying to figure out what to do. Well, now that's the option now. HAMP will modify a rental property, very, very important. But for principal reduction, it cannot be a rental property, just flat out. So that's one thing you can cross off your list, right? If it's a rental property, you're probably not going to get a loan mod. You're probably not going to get a principal reduction. So that's sort of where you segue into maybe a short sale, okay? So principal reduction is not going to happen on your rental property, all right? And the mortgage, same thing here. The mortgage got to be originated before January 1st, 2009. Remember I told you to memorize this date? January 1st, 2009. Most loan has to be before this date. So the mortgage payment, they're going to try. Now, your mortgage payment must be more than 31% of gross monthly income to qualify for this. And the same numbers again. Remember the loan balance I told you about? $729,000 for one unit, $934,000 for the second unit. Okay, memorize those numbers because they repeat themselves. So 729, 934, 1.11, 1.4. Those are the loan balance. Okay, all right. Same thing here. If you've had a felony in the last 10 years, you're not going to qualify. Okay, so just to give you a marker. How many loans, how many HAMP has been done? There's about 100 HAMP. I'm sorry, there's about 1 million. There's about 1 million permanent loan modification done, the HAMP program. But only about 100,000 PRA, pure principal reduction, only about 100,000. So about 10% or so, okay? All right, now, moving on to the next program now, okay? A lot of homeowners, or maybe yourself or your friends, has got the first loan modified. They modify the first loan. But what about the second loan? What about the second loan? Well, there's something called a second lien modification program. Now, I teach you this because you have to ask the bank for these programs, okay? Don't just say, hey, help me. Ask them specifically for the program that I'm talking about. So for your second mortgage, ask them, hey, do I qualify for the federal second lien modification program, the 2MP? Be specific, because if you just leave it to the bank to find the right program for you, I think that's challenging. You may not get it. All right, so this 2MP, so let's say if you have a HAMP that modified the first loan, you have a second loan, well, this program is for you. It's set to deal with the second mortgage. There is only 17 servicers. There's only 17 banks that participate in this program, the 2MP. But I want you to be aware of it, okay? The 17 servicers are all the big boys, okay? The Chase, the Bank of America, they do this. They deal with the second mortgage for you, the 2MP. All right? Eligibility. So your first mortgage has got to be permanently modified by HAMP. Okay? So your first mortgage got to be modified by HAMP. That's one criteria. And same thing, you cannot be convicted in the last 10 years. And the borrower have not missed 3 consecutive HAMP payment. Very, very important here. If you have a HAMP loan modification, you want to stay current to apply to deal with your second mortgage. Don't miss anything. It's got to be 3 consecutive payments, okay? You cannot miss the first mortgage, all right? So the 17 servicer participants, my website, paulhornlawfirm.com, go to the resource. You'll see who these 17 servicers are, okay? Next program. Next program. It's going to be the unemployment program. It's called a UP. Okay, it's called the Home Affordable Unemployment Program. So remember how I started off with my segment saying that, hey, if you're unemployed, there's a program for you. Well, this is it right here. This is a federal program. Okay? So this is a really big deal because loan modification requires a what? A job, right? Well, this, you don't need to have a job. You're unemployed, okay? Now, unemployed is going to meet. So this program, first of all, it's going to suspend your mortgage for 12 months or more. It gives you a gap, okay? Hey, if you're unemployed, talk to a realtor. You're the realtor. If you're unemployed, I can help you. Did you know the federal government will suspend your mortgage for 12 months to help you get over this tough time? But your unemployment, gang, your unemployment cannot be voluntary, okay? Meaning you can't just quit your job. and apply for this, okay? It doesn't happen that way. You gotta be, bona fide, truly unemployed, and this is sort of a way the government is dealing with unemployment. So unemployment now can be helped. So let's look at the criteria. All right, so you're unemployed. Now this is for primary house only. This unemployment program is only for primary resident only. And the borrower has not previously received a HAMP modification. So you never got a HAMP before, okay? And again, your loan has got to originate before January 1st, 2009. Remember, you got to ingrain this date in your subconscious, January 1st, 2009, because it comes up again and again. Same thing again, the loan balance. If it's more than $729,000, you're not going to qualify for this program, okay, for a single resident. This unemployment program is offered by the same 100 plus so servicer out there. The same, all that participate in HAMP also participate in this program. Okay, so let's sort of move on with this. At the end of this unemployment program, they will consider you for a HAMP modification. So you're unemployed now, you never had a HAMP before, this program is for you, okay? So I really want to stress this program. I think it can help a lot of homeowners with this. A lot of homeowners don't understand that this program exists, okay? Oh, by the way, this program, though, is not available with mortgages that are held by Fannie Mae or Freddie Mac. I'm sorry. If you have a Fannie Mae or Freddie Mac, this program's not going to help you, okay? Let me move on to, so we talked about, hey, if you need a loan modification, here's a program for it. If your house is so upside down, there's a principal reduction program. If you're unemployed, there's a program for it. Those are hardship, right? Let's say I'm current. I'm current, but I have a horrible, horrible loan. Is there help for me? So remember I said that this session is not strictly for distressed homeowners. It's for your friends and family who are not in distress, who are current. So for example, if you're current on your mortgage, but your house is upside down in value, this program is for you. It's called HARP, okay? Home Affordable Refinancing Program. As you all know, right? Very good interest rate. Your homeowner, your friends or family, or yourself may have, let's say, a 6.25% interest rate mortgage. I had 6.25% interest rate mortgage when I bought my house in 2006. I can refinance it now for 3.5, right? You're going to be their best friend. Oh my God, saving $1,000 on your mortgage is a big deal, right? It doesn't make you any money, but you're going to win friends and referral from it, right? Okay. So let's go over the criteria, okay? So this HARP program, it's got to be a Freddie Mac or Fannie Mae. Your mortgage got to be a Freddie Mac or Fannie Mae, okay? So the goal here, now, just a quick reference point. If your loan is a Fannie Mae or Freddie Mac, statistically, 10% is in distress. They're not paying their mortgage, so they won't qualify for this. This is for current. But the other 9%, gang, statistically, the other 90%, Fannie Mae, Freddie Mac are current. This HARP program is targeted toward the 90% of HARP. I mean, the 9% of Fannie Mae, Freddie Mac program, okay? It's a very good program, all right? So now, this HARP program, you don't have to just apply with your current servicer or current bank. You can shop around. Any lender, any bank can give you this HARP. Please pass this message to your friends and family. And when you are marketing out there, okay? Very important program. Eligibility. So your mortgage must have been sold to Fannie Mae or Freddie Mac before May 1st, 2009. So this is the first different date that I'm talking about, right? So HARP has got to be before May 31st, 2009. And the mortgage has never been refinanced before. The mortgage has never been refinanced on the HARP before. And now, this program is special in this way. If you were to go out and try and refinance your house, right? They look at your LTV, the loan to value ratio. If you're upside down, you're not going to be anywhere near the ballpark that a traditional bank would refinance you. But HARP says, hey, no problem. for an upside-down house where the LTV is greater than 80%, HARP will take it, okay? All right? But the main thing here is you got to be current on your mortgage. What's the definition of current? The definition is no late payment in the last 6 months, no late payment in the last 6 months, or you miss one payment in the last 12 months. You miss one payment in the last 12 months. That's the definition of current. Okay, let's move on. So what I talked about is Fannie Mae, Freddie Mac, refinance. But if you have an FHA loan, well, there's also an FHA short sale refinance program, okay? So FHA loan has their own refinance program. So for FHA, obviously, your mortgage is not guaranteed by Freddie Mac, Fannie Mae. So when it comes to refinancing, I want you to walk away with this. If it's a Fannie Mae, Freddie Mac, use HARP. If it's an FHA, it's a smaller program, obviously. Use the FHA short refinance, okay? FHA is for primary resident. For primary resident, you're current, okay? All right. VA, let's go on to VA. Let's go on to VA. If you have a VA program, there's also a VA refinancing program also. It's a very good program, you know. Let's look at the eligibility. Now, the VA, if you have a VA loan, when they refinance it, there's no credit reporting, no appraisal done. Okay, that's the big deal about it. They don't need an appraisal. They don't need to do a credit check on you if it's a VA loan. Very, very good program, okay? The only thing is no cash out. No cash out, and it's voluntary by the banks, all right? Okay. So, those are all the program, the federal program. Those are the federal program that exists to help you sort of fix your mortgage. What if I just hate my house? I don't want it. What if I truly cannot afford to live in this $1 million house anymore? So then there's, if it's a short sale, then obviously the federal government has the HAFA program, okay? The Home Affordable Foreclosure Alternative. Now, I'm just going to just sort of glide by HAFA. I want you to understand it. One thing I want you to walk away with this. There's one thing I want you to walk away with. You may have a client that has a home in another state. Have a home in another state, and that state is not an anti-deficiency state, meaning if you do a short sale, they can come after you for the difference. When that is the situation, you always refer your client to use HAFA. Let me repeat. Your client lives in California. Your client has a rental property, okay? And you want to make sure your client, when they do the short sale, they don't owe anything on the mortgage. You want to tell him or her, to tell a real estate agent in the outer state to use HAFA. Because HAFA is a national program that says no deficiency. It's not a big deal in California because California a lot deals with that. We're going to talk about it later. But for outer state, use HAFA to protect your homeowner because it mandates debt forgiveness, okay? HAFA program, remember that. If you have a home in outer state, use HAFA. It protects your homeowner. Okay, so the eligibility here, is that it can be your primary resident, it can be your rental, it can be 1 to 4 units, okay? You're delinquent, an eminent delinquent, the loan has got to be before 2009. The loan amounts are the same. The same loan balance we talked about, 729, 1.1, 729, 934, 1.114, same numbers appear again. Memorize those numbers, guys. It's the same number that keeps repeating itself. Okay? All right? So, HAFA is available for mortgages that are owned or guaranteed by Fannie Mae, Freddie Mac. Okay? All right. So, just to sort of recap, HAFA obviously does give your homeowner $3,000 to move out. So that's not so special in California, right? If California home, you may not want to use HAFA, but because banks are giving out, $20,000, $15,000 to move out. So in California, HAFA is not such a big deal, okay? But they, at a minimum, give you $3,000. They also give $8,500 to the second lien, right? Second mortgage, $8,500. But the thing about HALFA too is the $8,500 doesn't include, let's say you have a child support lien on the house. Let's say you have a mechanic lien on the house. HALFA will pay those separately above the $85,000. That's what HALFA can do. All right. So let me sort of move on. No cash contribution. Okay. The next program I want to talk about is the Neighborhood Stabilization Program. It's a federal program. All I want you to know about this is this. It's called the NSP. It's about $7 billion funding, okay? And it's set toward to help neighborhoods that are in distress, okay? They buy property, they fix it, they resell it. What I want you to do is this. In California, gangs, there's about 123 NSP. I want you to contact them, be their friend. Why? Because they have houses that need listing, okay? I want you to contact them. Maybe you can become the listing agent for these NSP, okay? Use it. It's a federal program. California has the money to do this. I want you to get to know the 123 or so NSP California program because you may get some listing from it, okay? All right, so let's move on, okay? All right, have you heard, on the radio, have you heard this advertisement, Keep Your Home California? Right, so what is that all about? Okay, so the federal government essentially created a hardest hit fund, and what that says is this. That hardest hit fund, they gave $7.6 billion to 18 states. 18 states as part of this program. The big four states, obviously California, Nevada, Arizona, Florida, are all part of this 18 state. Okay, California is the biggest. They got about $2 billion from there, California. Okay, California, the program is called Keep Your Home California. So just as a marker, $2 billion was given. Only $500 million has been spent. Only $500 million has been spent, so there's a lot of money left. There's a lot of money left in this program. Okay, so the 4 different type of program that California offer is this. The 4 different program is the unemployment program. Remember I said in the federal government there was unemployment program? Well, California also has its own unemployment program. Okay, we'll get into detail. It also has a mortgage assistance program. It's called the MRAP. It also has got the principal reduction program. And it's also got a TAP program, okay? Transition to help you move out. Okay, so let's drill down. Let's take a look at each program separately, okay? All right, let's look at the first program. Oh, by the way, so all these four programs have some sort of eligibility, okay? Now, you got to have an income. The 4 program is for low income to moderate income. So what does that mean? Just to give you an idea, in Los Angeles, your household income is less than $76,000. So in Los Angeles, if your homeowner makes less than $76,000, they qualify for the Keep Your Home California. In Orange County, we're here in Orange County. In Orange County, the number is 101,000. If your homeowner makes less than 101,000, they qualify for Keep Your Home California. Okay? It's only for primary resident. It's only for home location in California. Same thing here again. Your mortgage balance, you use the same number. Remember, 729, 934, 1.1, 1.4, same number appears. You memorize those numbers again, because those number repeats itself in all these programs. All right, so now this is the good thing about Keep Your Home California. Remember how I said for a loan modification in HAMP, your loan was originated on or before January 1st, 2009? Remember that? Well, Keep Your Home California extends it by 1 year. So if your loan was originated on before January 1st, 2010. You see, that's the main difference. So if you couldn't qualify for HAMP, well, now you can qualify for Keep Your Home California, because now, even if you got your loan in 2010, it still works. That's the main difference here for Keep Your Home California. Okay? And again, the income limit is by different counties. If you go to my website, you just look up the counties, and it'll tell you how much income you need to make, right? So once again, right, a marketing opportunity. Did you know that California has $2 billion allocated to help you? Let me help you. Why? Because I can see how much income you make to see if you qualifies, okay, and all the criteria. So let's go in detail. Let's go in detail. Let's look at the unemployment mortgage assistance. So now if you're unemployed, it's a California program. California pay up to $3,000 for 9 months if you're unemployed, okay, for a maximum of $27,000. So if you're unemployed, California Keep Your Home will help you. So a marketing point, right? If you're unemployed, did you know California will give you up to $27,000 to help you in this gap time? 27 grand unemployment compensation. In addition to whatever unemployment you're getting from EDD, okay? You're collecting an unemployment check. This is something separate. $3,000 per month for your mortgage. All right, so now, once again, income limits, right? You got to make less than $76,000 if you're in LA. Income limit, Orange County, you got to make less than $101,000, okay? You need a hardship affidavit. So now you have learned the criteria so far for Keep Your Home, right? So for someone unemployed, they make less than, let's say, $76,000 in LA County, call the servicer to see, hey, I'm looking for the Keep Your Home California program. I'm unemployed. You see, I'm teaching you these programs because you want to be program specific when you call the bank. Don't leave it up to the bank, because the bank will tell you, let me look for a program for you. No, tell them which program you want, okay? All right, let me move on to the Mortgage Reinstatement Assistance Program. So here's a marketing tip for you on this one. This program is essentially this. Oops, let me go back. California will give you up to $25,000 to catch up on your mortgage. Let's say you're behind. Let's say you're behind your mortgage, right? California would say, here's $25,000 to catch up, a one-time payment, okay? The income criteria is the same. Remember I said Orange County, $101,000, Los Angeles, $76,000. Example, Riverside County, $75,000. If you make less than $75,000 in Riverside, you're good. San Diego, it's $89,000. So there's an income limit, right? But you can go and find that number either from keepyourhomecalifornia.org or just go to my website, paulhornlawfirm.com, okay? This is a very good program because homeowner who falls behind on their mortgage don't have 25 grand to give to the bank, right? Apply for this program. You see, there's so many programs out there, okay? All right, let's move on. So this is called the MRAP, Mortgage Reinstatement Assistance Program. It will give you 25 grand to catch up on your mortgage, okay? California, another program. California has its own principal reduction program, okay? California has its own principal reduction program where it will reduce your principal balance by $100,000. It will give you $100,000 to lower your principal. A lot of homeowners cannot pay the high mortgage, right? Well, California says, we're going to give you 100 grand to reduce. We're going to infuse some capital into you to lower your principal so you can keep your home. So marketing point right here. Let me see if your loan qualifies for this 100 grand principal reduction, right? Do you know if your loan qualifies for $100,000 principal reduction? Let me show you how, right? That's your marketing point. Because it's true. This is a program, Keep Your Home California. Your homeowner will hear Keep Your Home California advertised. They know about it, but they don't know the detail that I'm telling you. Okay? So, principal reduction program will give up to $100,000 to lower your principal. Okay, so let's go on. Okay, the last program. The last program is that, let's say, once again, the loan mod doesn't work, you can't afford the house, or California will give you $5,000 to move out. This is called the TAP program, the Transition Assistance Program. California says, hey, here's $5,000 for you to help you with your security deposit, renting your next, wherever you're going, okay, $5,000 is very good. So just to recap, guys, just to recap for California, okay? If you're unemployed, we can help you. Up to $27,000, California will give you. If you're behind your mortgage, California will give you up to $25,000. Did you know that? California will give you $100,000 to lower principal reduction. There's so much out there, guys, for your marketing material. Be different. Be different, okay? All right, so remember I said, and I think this is important right here. If your homeowner has lost the home in foreclosure in the past 3 years ago, well, now they qualify again as a first-time home buyer. Okay? Go back to your old clients that lost their home in 2008, because there's a special program for them. California will give them 3% for the down payment. It's called first-time home buyer. So go through your list. Clients who lost their home that you sold a home to, they qualify for this program. Okay? It's ran by Cal HFA, Down Payment Assistance Program. It'll give you 3% as a subordinated silent second. You don't have to pay them back until you sell the house. So for those that has a hard time and obstacle for the down payment, well, this program is for them. Check it out. First-time home buyers, the definition is the last 3 years you didn't own a home. Okay, so for someone who never bought a house before, this program is for them. For those who lose a home in foreclosure, this program is for them. Okay, so check it out. Cal HFA, Down Payment Assistance Program. All right, let me move on. One last thing I want to cover as far as government program, the IDA, Individual Development Account. This is a matching program where your homeowner puts in a certain amount of money. The bank, certain organization will match it. It's a 3-to-1 matching program, okay? Where for every dollar you put in, they will match a certain amount of it for you to save for your down payments, all right? So these are all the federal government program that you can sort of talk about when you go when you talk to homeowners, okay? All right, so now let's move on, let's move forward. I'm gonna talk about now to the national, I'm gonna talk about the National Mortgage Settlement. Okay, so take a deep breath. Here we go. Okay, so this national mortgage settlement is this. Essentially is this. Oops, let me go back. Essentially, banks. Remember in 2010 there was robo-signing. They were foreclosing on houses without proper documentation, right? The federal government did an investigation and say, hey, bank, you did wrong. You committed robo-signing, you committed fraud, you committed improper lending practice, improper foreclosure. So in response, the bank said, okay, we're going to give $25 billion back to the homeowner in various forms, $25 billion, okay? All right? So essentially, that $25 billion goes to a principal reduction refinance program. So the question is, how do I know whether this settlement affects me, right? How do I know if I'm going to be affected or benefit from this settlement? Okay, so let's knock off the easy one first. If you're in Oklahoma, you don't qualify. I don't know why Oklahoma just decided we don't want this. Anyway, they're not part of the settlement. Okay, Oklahoma, don't worry about this program. Okay. So, how do you know if you qualify for this program? How do you know? I'm going to tell you how if you don't qualify. Let's work from that end, okay? I'm going to give you a bunch of criteria, and if those criteria knocks you out, then you're out. Okay? So I'm going to work sort of backward. I'm going to tell you if you don't qualify. Here we go. All right. So just a little background. This $25 billion national mortgage settlement, February 2012 was when they signed the settlement. October 3rd last year was when these banks had to get their act in order. That's why you're seeing so many principal reduction now, okay? All right. It's the largest mortgage settlement ever in history, all right? So what does this mean? What does this settlement mean? Because it's meant to reduce principal reduction. It meant to help a lot of homeowners keep their home. All right. Oh, one more thing. This settlement, it does encourage short sale as well. Why? Because part of that $25 billion, when the servicer do a short sale or agree to a short sale, they get money for it. It counts toward the settlement that they agreed to, okay? All right, so which bank qualifies? Which bank? There's only 5 banks. There's only 5 banks that qualify. We're looking at Bank of America, JP Morgan Chase, Allies, Citibank, Wells Fargo. These are the only 5 banks, guys. These are the only 5 banks that qualifies, okay? Hey, these 5 banks, they essentially service 50% of the mortgage out there. So this settlement covers about 50% of the mortgage out there. Okay. All right. So remember I told you it's hard to say if you qualify or not. But I'm going to tell you if you don't qualify. If your loan is a government loan, meaning if your loan is a GSE loan, government-sponsored enterprise, if your loan is a Fannie Mae, Freddie Mac, so sorry. You're not going to get principal reduction. If you're a Fannie Mae, Freddie Mac, VA, HUD, you're out. Okay? Now, so see, that's another marketing point, right? $25 billion are meant to help homeowners in a separate program from everything else. But let me help you see if your loan qualify, right? Marketing point. Because it's true, it's real. There are a lot of homeowners that gets the second wipeout, that gets principal reduction, it's real. Use it to help your homeowner. But if it's a government loan, there's no help. So remember, I keep saying, if it's a Freddie Mac, you don't qualify for certain things. It's a Fannie Mae, you don't qualify for certain things. How do you know if your loan is Fannie Mae or Freddie Mac? Go to this website right here. Go to this website for Fannie Mae. It's going to be fanniemae.com/loan lookup. You go there to find out if that homeowner is a Fannie Mae loan. Okay? If it's a Freddie Mac, you're going to go to freddieMac.com/mymortgage for Freddie. So freddieMac.com/mymortgage to find out if it's a Freddie loan, okay? So this is something you can do for your homeowners. Let me help you see which government criteria you fit into. All right, principal reduction. Remember I said that the bank's going to give $25 billion? Remember I said the bank's going to give $25 billion back to the homeowner? Okay? All right. 10 billions of it goes to a principal reduction. Pure principal reduction, 10 billions of it, all right? Criteria, you owe more on your mortgage and you're delinquent, okay? So let's look in detail the criteria for a principal reduction. Oops, let me go back. Okay, so to get a principal reduction, you got to be at least 60 days late as of January 31st, 2012. So 60 days late as of January 1st, 2012. You're underwater. You've never defaulted on a HAMP, loan modification. Okay? And your loan cannot be a Fannie Mac, Freddie Mae, FHA HUD loan. Okay? So, just to recap, you're 60 days late as of January 31st, 2012. You're underwater. You haven't defaulted on HAMP. You're not a government loan. But this is also very important. Remember I said there are 5 banks that are involved in this, 5 servicer? If you're Wells Fargo, Citi, or GMAC, if you're Wells Fargo, Citi, or GMAC, they have to own your loan and service it. They got to own it, right? Because some banks are just servicing it for an investor. If you're part of those 3 banks, they got to own it. If you're Bank of America or Chase, then it's a little bit easier. They can just service it or own it, or they're just servicing it, but they have the complete authority to modify your loan, okay? So it's a little bit easier with Bank of America and Chase. All right, so Bank of America is the biggest bank. Bank of America will send out solicitation letter to your homeowner. So have your homeowner open up the mail, because it may say, hey, your second mortgage is forgiven. Okay? Open up their mail. So here's how it works. Bank of America will voluntarily send out a letter that says, hey, we've forgiven you for your second mortgage. What do you have to do to get it? Nothing. Just shut up for 30 days. That's what it says. You don't do anything for 30 days, you get it. If you say something, if you don't want it, then say something in 30 days. And then what's going to happen is that they will mail you a reconveyance after that. Okay? Bank of America is doing a lot of second mortgage forgiveness. They'll send you a letter that says you're forgiven. Just don't do anything in 30 days. About 60 days later, they mail you the reconveyance that says, hey, that lien is off now. Okay? Wells Fargo, Chase, Citi, Ally, those four, they're not subject by the same, they don't do solicitation. You have to call them and find out. Okay? So Bank of America, principal reduction. Now, Bank of America has their own criteria. Now, I talk about Bank of America a lot because they are the biggest servicer. It affects a lot of people. Your current mortgage is 25% or more. You owe more on your first mortgage than your home is worth. You're 60-day delinquent. You have not defaulted on a HAMP. Okay? So if you're a Bank of America and you're part of the countrywide loan, call them. Call them, okay? All right. The $25 billion mortgage settlement also has a second mortgage component to it. Bank of America will solicit. They will solicit homeowners and says, hey, I forgive you for your second. The other four banks are a little bit different. The other four banks says that it varies, but primary, when the first is modified, then they do the other one as well. Okay, the other four banks are a lot more tougher when it comes to a second mortgage. So if you have a Bank of America second mortgage, that's a good sign. You may get it forgiven. All right, $3 billion of the 25, another $3 billion goes toward refinancing. Okay, another $3 billion goes toward refinancing. It's a very good program. How do you qualify for refinance? So here's our criteria. To qualify for refinancing under the National Mortgage Settlement, your loan has got to be serviced and owned by the same bank. You're underwater. You're current. Refinancing seems to have that component. If you're current, then you qualify for refinance. If you're not current, then you got to look for all the other program we talked about, okay? All right. Your interest rate has got to be more than 5.25% for this refinancing under the mortgage settlement. And your loan balance, same thing. Remember I asked you to memorize these numbers? Because it matters. These numbers matter. 1 unit, 729, 2 unit, 934, 3 unit, 1.1, 4 unit, 1.4 million. The same number comes up. And your loan, once again, it's got to originate before 2009. It's got to originate before 2009, okay? $7 billion of the 25 goes toward your short sale, okay? So remember, short sales are easier now, partially because of this program, okay? Now, I want to say something here. A lot of you, some homeowner thinks short sale is hard to do because they're current or because they have a lot of money, whatever it is. Foreclosure is a dirty word now. It is. Banks don't want to foreclose on you. They want to do short sale. So a program like these helps you with your short sale. You just need to take everything that I'm teaching you today, go out there and help people. Okay, let's move on. $5 billion goes to wrongful foreclosure. If you get a check from Bank of America or something like that, it's a good check, cash it. Seriously, I've had homeowner call me and says, hey, I got $1,500 for wrongful foreclosure. Can I cash it? Yes, cash it. Okay? So just keep that in mind. Your homeowner is getting checks for foreclosure. Cash it. It's good. All right. So the process. So these 5 banks are going through their loan to see who qualifies. And if you do qualify, they reach out to you. But individually, I want you to use this in your campaign, okay? It's only going to last until 2015. So for the next 3 years, use it in your marketing material. Okay? Do you know if your loan qualifies for principal reduction? Let me show you, let me help you, right? Very, very different. I know you're in foreclosure. The trustee says so. I don't know what the reason is, but if you're unemployed, there's a program for you. There's $25,000 for you to catch up on your mortgage. You see, it's a different feel, right? I'm not here to take your house away from you. I'm here to help you. So far, I've been standing out here for about an hour. I have not sold you one thing, right? It's all about helping the homeowner. You got to go out with this spirit, and you're going to get a lot of business. Okay, let me move on. California Home Bill of Rights. California Bill of Rights. So, why? What's the big deal about this law, right? What's so special about it? Okay, so this law was signed into law July 2012. It came into effect July last year, okay? And it went into effect this year, January 1st, 2013. It's important because in January this year, foreclosure dropped by 62%. Huge drop, and the drop has to do with this law right here. Because banks are basically scrambling to see, hey, they don't want to violate this law. So let's talk about this law. Let's see how you can help the homeowner at the same time use it as a marketing vehicle, okay? So this law, when it first came out, just sort of a background, when it first came out, your CAR, C-A-R, right, who you belong to, they didn't like this law. They said, you know, this law is going to encourage more lawsuit. It's going to slow down the real estate market. That's what CAR is saying. California Attorney General says, no, it shouldn't. It should increase the flow of real estate transactions because everybody now knows what they're doing. We'll see. But for right now, foreclosure has sort of slowed down because of this law. Let's get into the law. All right. So now, just real quick, this law is just it's not just what we're going to talk about. What we're going to focus today is really called the Foreclosure Reduction Act, right? That's really what we're going to talk. Foreclosure Reduction Act is really part of the California Home Bill of Rights. So your marketing tip. Do you know if the Foreclosure Reduction Act is going to help you? Let me help you, right? California don't want foreclosure. Do you know what the law is? Let me help you. That's what you should have in your marketing flyers. Okay, so anyway, so it's a package of bill. It also addresses tenants. So for those of you dealing with investor, buying short sale, we're going to talk about that, how to protect your investor, okay? So something very important to remember is that the California Home Bill of Rights is going to end one day. It's going to end in 2018. 2018 is going to come to a stop. The $25 billion settlement is going to last for the next 3 years to 2015. So those are the 2 days I want you to mentally keep in mind, okay? They do have, it's time sensitive, put it into your marketing material. Okay, so real quick, let's talk about the purpose. What's the purpose of the California Homeowner Bill of Rights? The purpose is to give the homeowner a more meaningful opportunity to avoid foreclosure. Okay? Remember that, guys. Whenever you run into a problematic transaction and the bank is trying to foreclose your house, come back to why we have the California Home Bill of Rights. And the idea is to give the homeowner a more meaningful opportunity to seek loss mitigation, AKA a loan modification, AKA your short sale. This law is very broad. Always come back when the lender is threatening to foreclose on you, give them the California Home Bill of Rights speech, okay? Seriously, it has worked for a lot of my students, okay? Because the spirit of the law is, hey, foreclosure hurts everybody. We don't want that, okay? And this law said that, hey, you got to give the homeowner all the breaks in between to seek a short sale, to seek a loan mod. Let's move on. So let me just give you the highlights of the California Bill of Rights. First of all, it's modeled after the $25 billion Attorney General settlement. It basically heightens the pre-foreclosure outreach and communication. It's got an anti-dual tracking requirements, and documentation requirements. Okay, the bank's got to do a lot more now before they can foreclose. And it's always got private right of action. Private right of action, that's just a fancy word of saying before the bank sell your house, you can actually sue them under the California Home Bill of Rights, and the judge will issue a TRO, a temporary restraining order, against them selling your house. Okay, so let's get into detail. This California Home Bill of Rights only affects the first mortgage. Only affects the first mortgage, primary resident, 1 to 4 units. Okay, so it only affects the first mortgage, 1 to 4 unit. But that should be sufficient, right? Because the second mortgage normally don't foreclose on you. It's only the first. So the first mortgage just gets affected, all right? Also, it doesn't apply to your hard money lender, unfortunately. Why? If your hard money lender trying to foreclose on you, California Home Bill of Rights doesn't apply to them because it only applies to a servicer that does more than 175 foreclosure per year. So if the second is foreclosing on you, this law doesn't apply. If a private lender is foreclosing on you, unless they do more than 175, yes. But it should be, this law is targeted toward the Ocwen, the Nation Star, the Bank of America, so plenty of everybody else will get affected except private lender. Okay. A very key component that I'm going to get into is called SPOC. Basically, in the past, your homeowner called the bank 50 times, right? Probably talked to 50 different people, telling them 50 different stories, no more. This law says, hey, remember going back to the meaning of what they're trying to do was to foster more meaningful opportunity. What this law says, you got to assign one team or one person to deal with the homeowner. This one person or one team, it's got to tell the homeowner what document they need to do the loan mod, to do the short sale, and when they should get them in. So it's called a single point of contact. It's very important. It's meant to say, hey, bang, enough of your shenanigan. One person, one team to help the homeowner. It's very important. And so once again, this law, it does expires, okay? I'm sorry, this law doesn't expire, it will go on. The majority is going to expire 2018, but some portion of it will go beyond 2018. Like this SPOC, single point of contact, it's going to survive 2018. Okay, let's go on. So before foreclosure, before they can record an NOD on you from here on out, before they can do that, the lender has got to send you a letter saying, hey, I'm going to put you in a foreclosure. Would you like a copy of your history payment? Would you like a copy of your promissory note? What other documents do you want? So now you have a chance now to say, yeah, give me all my documents. I want to see it. Okay? So this is something they must do before they record the NOD. Okay. So now, after they send you that letter that says, hey, you're entitled to get all these documents, they got to wait 30 days before they can initiate the foreclosure. Okay? All right. So like for example, if you do a loan modification, okay, there's nothing they can do. They got to process it before they can do anything else. Okay. So very, very important. I think this is probably one of the biggest law for California Home Bill of Rights. It's called the anti-dual tracking provision. So what this law says is this. It's a very good law that says the homeowner is not paying their mortgage, right, for some reason, whatever, and they're not in foreclosure. Okay, let's say they're 6 months into it. They haven't received the notice of default. Okay? This law says if the homeowner submit a complete loan modification package, now remember that word, complete. If the homeowner submit a complete loan modification package, then they cannot process the foreclosure. What does that mean? If you haven't paid your mortgage in 6 months, you're not in foreclosure, if you submit the complete package, they cannot record the notice of default. They cannot do it. Let's say you're a year into foreclosure, you've got the notice of default, and now you finally submit the loan modification, then they cannot record the notice of trustee sale. They just cannot do it. Okay? In the past, California did a research that shows that about 32% of all homeowners lost their home while they thought they were doing a loan modification. This law says no more of that shenanigan, okay? When you're processing my loan mod, you can take forever to do it, but you may not foreclose on me. Very, very good law, okay? So, right? So, marketing tip. Did you know the California Home Bill of Rights can stop a foreclosure? Let me help you. Right? Because it's true, this is the law. So if someone has a foreclosure, you can literally help them stop a foreclosure by submitting a complete loan modification. All right, let's move on. So, let's say you do a loan mod, you get granted, wonderful, no foreclosure. But what happens if you get denied? You do a loan mod, you've been denied of a loan modification. You've been denied. So once you're denied, they have to send you a letter. They have to send you a letter that says why they deny your loan modification. Okay? If it's a net present value issue, the bank's going to tell you the number they use in arriving at denying you, right? Because remember, I told you, the purpose of the law was to give you a more meaningful opportunity to seek loss mitigation, right? So now you can take that denial letter and go see your attorney. You can take that letter and go see your HUD counselor and see, hey, is this true? Can they deny me? Does all the number make sense? That's what makes this law powerful. And that's why the bank has slowed down foreclosure, because they don't want to violate this law. Okay, so that's a very critical. When they deny you, they got to wait 30 days before they can foreclose on you, okay? So now why wait 30 days? Why wait 30 days? Because of this. Oh, before I get there. So let's say they haven't recorded the NOD. You're not in foreclosure yet. And when you receive a short sale approval letter, you're not in foreclosure, they cannot record the NOD if you receive a short sale approval. If you are complying with all the terms of the short sale approval, they cannot process the NOD. Let's say it's post-NOD. You receive an NOD, and this is probably the situation you're all faced with. You receive an NOD, there's a trustee sale, and if you have a complete short sale approval, they should not be recording a trustee sale on you if you are if you're following through with a short sale approval, right? Very, very critical for you to remember, okay? And let's say Bank of America gives you a short sale approval, but then they sell that loan to NationStar. So do you have to start all over? The rule is no. This law says NationStar, whoever else takes this on, Aquan, whoever it is, it's got to take that short sale approval. You don't have to start your process over, right? So this law is actually a very good law to help you complete your short sale as well, okay? All right, so let's move on. Remember I said, what happens if you receive a letter and they deny you, right? So when they deny you, you can actually appeal the process. You can actually appeal it, and the law is once you appeal it, they got to wait at least 15 days. You got to wait at least 15 days to process your foreclosure again, okay? So very important to remember. All right, let me move on. Trustee sale, from here on out, starting this year, if they postpone your trustee sale more than 10 days, they got to send you a letter. And that's some banks are getting smart now. They're only going to postpone it for 1 week only, so they don't have to comply with this law. So you see banks are trying to figure out this law as well, just like we're doing. All right, so again, enforcement of this law, California Home Bill of Rights draws a line in the sand, okay? It says if you have a beef with the lender, do it before the trustee sale. Because once the trustee sale happens, you cannot go back and try to regain your house using the California Home Bill of Rights, okay? It draws a line in the sand that says before trustee sale. Okay, so Now, let's move on to short sale law. Let's move on to more substantive law, okay? All right. Let's talk about California foreclosure law, short sale law, okay? So, in California, there's two ways they can foreclose on you, right? One way is the non-judicial foreclosure process, and one way is the judicial process. That's just a fancy word of saying, hey, in California, I can take your house away in two manners. One is I can sue you in court, or the other common way, and 99.99% of the time, they do it in the NOD trustee sale fashion. Do you ever wonder why they do NOD trustee sale? It's cheaper, it's true, it's faster, it's true, but here's the real reason. If they choose to take you out in court, and let's say you owe the bank $500,000, the house is only worth $300,000, it's upside down, right? You owe $5, the house worth $3. If they take you to court, you have 1 year to pay the $500,000 and get the house back. 1 year! You think that would create a nightmare for the bank. That's why they don't go there. Okay? If you owe $300,000 and the house worth $500,000, then you got 3 months of redemption period. That's why, folks. That's why you don't see court proceeding foreclosure in California, because it gives the homeowner a whole freaking year. That's gonna wreck the system, right? That's why they don't do that. Okay? So let's move on. All right. So in California, just remember, NOD trust sale is the most common way. So just as a pointer, where you're dealing with a homeowner, you're talking to the homeowner, and they say, I need help, right? They haven't paid their mortgage. So the first thing that should come to your mind is this: when you're talking to a homeowner, you should always find out, has an NOD been recorded? Has a trustee sale recorded? You ask the homeowner, they're not going to know. You know why? Because they're going to have a stack of mail that's unopened. Just pick up the phone. Just call your title company to send you a property profile, right? That's going to show exactly that if an NOD has been recorded. The first thing, really, guys, when you get a referral, is always just pull the property profile. That's going to show you when the NOD was recorded, if there's a trustee sale coming up. And that's going to help you with your deals, because maybe you don't have time. Maybe the trustee sale is 2 weeks away, right? Okay, always pull the property profile. And most title company will give you that for free, okay? You always do that. Okay, so let's move on. So something I want to talk to you about is non-recourse. Remember this rule, non-recourse, okay? It's important. Non-recourse is the same thing as purchase money. And purchase money, non-recourse loan, all it means is this: when they foreclose on you, they cannot come after you. That's all it means. Non-recourse loan only applies to your primary house, 1 to 4 units, and you never refinance the house. Okay? It's the original money. So remember, this is going to make you money. Write this down, please. If it's a purchase money, non-recourse loan, you don't ever owe the bank any money in foreclosure. You don't ever owe any tax money either. We're going to get into tax a little bit later, but I want you to write this down, okay? If it's a purchase money, you never touch the money, it came with the house, you don't owe anybody anything in a foreclosure or to the taxing authority. All right, and remember, purchase money only applies to primary resident, 1 to 4 units. Okay, crucial. So if it's a rental property, doesn't work. But you say, hey, Paul, I bought that house 2 years ago, but then I moved out, and I came back, I moved out. How? Is that primary or rental? Well, we always look at the original agreement, the 1031. The 1003. The 1003 is where you designate, you told the bank, hey, bank, I'm going to use this money for my primary resident. If that's what it says on there, and you never refinanced it, even though you came in and out of it, for California law, it retains its character as a non-recourse loan. Okay? Something to remember. All right, let's move on. So we talked about non-recourse loan. It's a very good loan. You don't owe any money. Now let's move on to the recourse loan. Let's move on to the recourse loan. Recourse loan, it says, hey, when the bank comes and take your house away from you, they can also go after you personally. Okay? What type of loans are recourse loan? Recourse loan are vacation home, HELOCs, investment properties, refinance property, a refinance second mortgage, okay? So anytime you refinance your house, it's a HELOC second, it's a rental property, it's a recourse loan. And remember, recourse loan is just a fancy word of saying, I'm going to take your house away from you, and I can come after you too if I choose to. That's all that means, okay? So anytime someone has a second mortgage, a rental property, that issue has to come up. It's a recourse loan, okay? And we'll get into that a little more. Okay, so I want to introduce you to the first rule, okay? Civil Code Section 580D. Civil Code Section 580D, what it says is this. Now, you've all heard California is an anti-deficiency state, or what the heck does that mean? All this means is this. This is all it means. If the bank take your house away from you, they're finished, done, goodbye, good night. That's it. But listen carefully what I just said. When the bank, which bank, right? When the bank, which bank? Whichever bank is foreclosing on you, right? If the first is foreclosing on you, you owe them $500,000, the house only worth $300,000. When that bank, the bank, is foreclosing on you, they're finished because of that law you see on the board, Civil Code Section 580D, as in Delta, okay? So that's the first law to remember. Now this okay, so let's just keep that in the back of your mind. We're going to do some example later. And also I want to introduce you to the one form action rule. What that says is this. What that says is whoever does a foreclosure on you, they're done, they're finished. They cannot come after you and say, hey, sue you later on. They got one bite at the apple. That's sort of what the one form action rule says. Okay, so let's do an example together. I bought a house in 2006. Currently, I owe $350,000. The house only worth $250,000. It's it. I lose my house. I bought my house 2006. I never refinanced it. So the number I owe $350,000. The house worth $200,000. If I lose this house in a foreclosure, do I have any liability? The answer is no. Okay? Because it's a purchase money, easy. And this example, even though it doesn't matter how they foreclose on me. They can sue me, they can kick me. It doesn't matter. If it's a purchase money, it's a non-recourse loan. Non-recourse loan, you don't owe anything. You got to walk away with that. In a foreclosure, you don't owe the bank any money. In a purchase money, where you didn't touch the money, you didn't refinance the money, you don't have to worry about the bank suing you either, okay? All right, let me move on. I bought a house in 1985 for $50,000. $50,000. But you know what? I refinanced it a gazillion times, and now I owe $350,000. But the house only worth $250,000. Yeah, I only spent $50,000 to buy it. I refinanced it a gazillion times. Now I owe $350,000. The house only worth $250,000. In a foreclosure, do I owe any money? Right? That's the issue now. Okay? So you learned the law already. Remember, it's whoever foreclosed on you, they're finished and done. They're finished and done. Okay, well, foreclosing you. That's what that example tells you. Okay. Civil Code Section 580B, that just says, hey, in a purchase money, you don't owe anybody anything in a foreclosure, to make it simple. Okay? 580B is in boy. 580B is in boy, only apply to purchase money, 1 to 4 units. All right? So, let's do another example. Let's say I bought my house in 2006. The first mortgage is $350,000. The house value is $250,000. I never refinanced it, and the banks decide to sue me. The bank decides to sue me. Well, if it's a purchase money, I don't care if they sue me. They cannot touch me. If it's a purchase money meaning you never touched the money, you never refinanced it, then you're good. Okay, you'll go. Okay? Let me introduce you to another law. You should write this law down because it makes you money. This is your short sale law right here. Civil Code Section 580E as an echo. This law says this. This law says that when you do a short sale in a primary residence, in a rental property, it doesn't matter. You just don't owe the bank any money after that. Okay? So if you are stuck in a very bad mortgage, first mortgage, a second mortgage, this law says do a short sale, you don't owe the bank any money. Period. Okay? Civil Code Section 580E. Now this law came into effect July 15, 2011, July 15, 2011. Okay? All right, so let's walk through an example together. Let's do an example together. I owe the first mortgage $350. I owe the second mortgage $150. The house is worth $300. Does this ever happen in California? Right? I owe $500. The house is worth $300. All right. The second mortgage, the $150, I had a really good time with it. I bought a Porsche, and the Porsche is sitting in my garage. So I'm in trouble now. I can't pay my mortgage, right? So what do? So in this example, let's just talk about this real quick. Let's say I have a foreclosure. The first mortgage is going to foreclose on me. I have two mortgages, right? The first foreclosed on me. You learn today that they're finished. You don't owe them one penny. But the second mortgage, the 150 HELOC, is going to hang around. It's going to hang around, okay? You're going to be liable for the second mortgage. And what I'm telling you is the Civil Code Section 580E that you wrote down previously, the short sale, if I did a short sale, then I can keep my Porsche and get rid of the 150 HELOC. Okay? That's why this law is important. Okay? So your homeowner says, I'm going to lose my house anyway. Why should I participate in a short sale? Well, because if you lose your house in a foreclosure, you're liable for the $150,000. The bank's going to come after you and sue you and garnish your wage. See, right? I don't need to sell you the short sale, right? I'm looking after number one. Who's number one? The homeowner, right? Now, many of you have heard me say this. No one gives a damn about your commission, okay? Seriously, no one does. But the homeowner really are concerned about their liability, right? If they lose their home, they're liable for the 150. But if you do a short sale for them, you don't, because of this law that we talked about. Civil Code Section 580E, because of this law, allows you to do a short sale that, by law, helps the homeowner avoid any liability. Okay? So, so that's the example we went through, all right? So remember that example. It's going to help you in certain situation where there's a second mortgage involved, your homeowner is going to be liable in a foreclosure. That is money. You got to know that law. You got to know that law. In a second mortgage, sometimes you're liable. Sometimes not good enough, right? But when is sometime? When someone has a second mortgage, this is what I want you to go through. Write this down. When someone has a second mortgage, the first question you should ask them is, this house right here with the second mortgage, is it your primary resident? Pure and simple. Is it your primary resident? They said, let's do an easy one. They say, yes, it's my primary resident. Okay? Next question, how did you get that second mortgage? How did you get that second mortgage? They say, I don't know. What? And it's true, right? They may not know it because maybe it's an 80-20 loan, a 90-10 loan, right? Maybe it just came with the house. Remember the ninja loan? No income, no asset, no problem, right? Okay? So if it's a primary resident ninja loan, well, they don't owe anything on the second mortgage, okay? So that's one direction. If you ask them, do you live there? Well, back up. So they said, second mortgage, how did you get it? They say, I don't know. Okay, fine, so there's probably no liability. But if they said, well, I used it to buy a Porsche, right, it's a HELOC. I use it to improve my house. I took some money out and improved my house. Or it's a refinance second. So any of those situations, when it's a second HELOC, it's a second refinance position, even though your house is gone and you live there, there's no law protecting you. You're liable for the second mortgage in a foreclosure. But if you help them do a short sale, they will not be liable for that. Very, very important to remember, okay? Very, very important to remember. Okay. Now, going back. Do you live there? No, I don't live there. It's my rental property. No, it's my vacation home. As soon as you hear the word rental property, vacation home, stop. They're automatically liable for the second mortgage. That's California law. Okay? A rental property, if you have a second mortgage, you better do a short sale, because even though your home is gone for a rental property, you're still liable for the second mortgage. Okay? Very, very important to remember. Okay? All right, let's move on. So let's do an example together. Let's do an example together. I owe the first mortgage $550. I owe the second mortgage $150, and it's a HELOC, right? I used it to start a business. It failed, so it's a HELOC. I took some money out from my house. The second mortgage is a HELOC. The value of the house is only $525. That's the value of the house, only $525. Trustee sale is tomorrow. So this may be your client, okay? Let's say I come to you, hey, these are the facts. I owe $525 on the first. I owe $550 on the first. I owe $150 on the second. The house only worth $525. Give you a little more facts. Let's say my monthly mortgage payment is $2,000. Yeah, I normally pay $2,000. But you know what? I haven't paid in 15 months. So let's say I owe $30,000 in arrears. I owe 30 grand in arrears, okay? And let's say credit card debt. I also owe 80 grand. Okay. So point number one. Point number one. Anytime you have a homeowner in distress, ask them, what does he like to do with your house? Don't be afraid to ask them. What does he want to do with your house, right? Because remember, they are the boss. Don't be afraid to hear the word, I want to keep my house. Because what good is it for you to sign a short sale listing agreement, work so hard on it for 6 months, just let the homeowner say, I don't want it, right? Because they never really wanted it in the first place. That's how you go bankrupt yourself. So ask up front, what do you want to do with your house? They say, I want to keep my house. Okay, fine. You want to keep your house. Next, how much money do you make per month? Right? Because if you don't make any money, I'm so sorry. You cannot live in that $500,000 house. Can we all agree on that? Okay? So let's be very fair. If you want to keep the house, let's help you keep it. But do you make any money monthly? Do you make any money? Let's say in this example, let's say they make $5,000 in this example. Let's just say that, okay, an example. They make $5 grand. Hey, I lost my job. I got my job back. I make $5 grand. I want to keep this house. So in this example, you can, let's say you call the bank, you try to postpone the sale, they won't do it. The trustee sale is tomorrow or next week. I want to keep the house. What can I do? Well, they can file bankruptcy and stop the sale of this house tomorrow. Okay? They can stop it. When they file bankruptcy, they can keep this house permanently. No more foreclosure, no more trustee sale, house sold. If they file a Chapter 13, they can stop it totally. Before I get into a little more of the, well, let me just finish this. So if they file a Chapter 13 bankruptcy, they pay the regular mortgage, the $2,000. That was what they normally pay in my example here. And let's say the arrears, they owe 30 grand. I take that 30 grand, I divide it by 60 months. That's 500 roughly, right? So if they pay the 2,000 plus the 500, we can eliminate the second mortgage. We can eliminate the credit card debt. So now all their income goes toward keeping the house, okay? No more trustee sale. They can keep the home, but at the same time, that also means no short sale for you. But I think you should look at it this way. If this was your best friend, he's got 4 kids, wouldn't you want this option for him, right? And if you have a happy client, you're going to get a lot of referrals. But hold on a second, guys. Hold on a second. Just because I put someone in a Chapter 13 bankruptcy doesn't necessarily mean they're going to keep making the payment. And when they don't make the payment, Now is your short sale. Okay? So don't forget, chapter 13, keep your home, allows you to stop it. Now, I want to just touch base on this. There's a lot of bankruptcy. There's only 5 types of bankruptcy. There's only 5 types. Write this down. Write this down. 7. There's a chapter 7. There's a chapter 9. There's a chapter 11. Well, let me just give it to you, right? 7, 9, 11, 12, and 13. Those are the only 5 bankruptcy. Okay? So I want you to write this down. Let's do a little exercise together. Write those down for me. Just write 7, 9, 11, 12, and 13. Just write it down, okay? So a homeowner says, let's do bankruptcy. So the question is, what type of bankruptcy? What chapter, right? So let's do an exercise together, okay? Everybody wrote those numbers down? 7, 9, 11, and 13? And 12, sorry, 12, okay? So the question, what type of bankruptcy should I file? These are the only 5 that exist. So grab your pen, let's play a little game. Let's play a game of elimination, okay? If I'm the government, if I'm the city of, remember the city of San Bernardino filed bankruptcy? Stockton filed bankruptcy? They will file a chapter 9, okay? So your homeowner is not the government. Put an X by chapter 9, okay? So 9 is out. I now have 4 left. Chapter 12 is for farmers. Your homeowner is not a farmer. X that out, right? And of course, you know your avocado tree in your backyard doesn't make you a farmer. So take that out, okay? So now I'm left with 7, 11, and 13. Right? I'm narrowing the field. Now I have 7, 11, and 13. Our homeowner, if he owes more than $1.1 million in the mortgage, if he owes more than 1.1 million, more than 1.1 secured debt, then he will file a chapter 11. Well, that's not our client, right? Our client doesn't owe more than 1.1 million in mortgages, so scratch that out. Taking 11 out. So now you're left with 7 and 13, right? You all have that? Okay. So in my previous example, if I made money, I can file a 13 to keep my house. In that example, I made $5,000. What happened if I only made 3,000? Well, a chapter 13 is not going to do it because I don't make enough money, right? Remember I said in a chapter 13, in my example, I had to pay my regular mortgage, which is $2,000. And I had to pay the mortgage arrears, which is $500. I only make $3,000, so that only leaves me with $500 left to pay for my gasoline, eat, utility, right? It's not going to work. The court's not going to allow it. In that case, a 13 doesn't work. You put an X by a 13, right? Now I'm only left with a 7. Okay? A 7. Let's talk about chapter 7 for a second. In my example where the trustee sale is tomorrow, right? Let's say I don't do anything. I have 4 kids. The house goes into foreclosure tomorrow. I'm going to get a 3-day notice, right? I'm going to owe the $150 HELOC, right? Because it survived foreclosure. You learned that today. And I still have $80,000 in credit card debt. So I'm heading down for bankruptcy anyway. But if I file chapter 7, I can stop foreclosure tomorrow, wipe out all my debt, postpone the sales, and then you can possibly do the short sale after that. So that's how bankruptcy is played out, okay? All right? One more thing I want to touch about bankruptcy is this. One more thing. I want bankruptcy and short sale. If you're doing a short sale and the homeowners file bankruptcy, then what? Okay? Well, if it's a chapter 13, you need to file a motion for sale to continue your short sale, okay? File a motion for sale to do your short sale. If it's a chapter 7, you need to file a motion to abandon. What does all this mean? All this means is that even though the bankruptcy is active, you can still get your short sale through if the bankruptcy attorney filed this motion for you, okay? I do that in my office. I do that all the time, day in, day out, okay? It's just a coordination of how we get to it, okay? So keep that in mind. We're down to our last topic, guys. Getting tired out there? No. All right, last topic. Here we go. Last topic. Last topic. IRS, right? Okay, so the bank gave me $500,000 to buy a house, right? I owe $500,000. The bank literally gave me $500,000. Okay? I bought a house in 2006 for $500,000. And I'm in a foreclosure. I'm in a foreclosure. My house is only worth $300,000. Or I do a short sale. It's only worth $300,000. So the bank does the short sale. Let's say the bank only gets back $300,000, right? The bank gave you $5,000. They only got back $300,000. Does everybody follow that? Yeah. So the question is, do you owe tax on that money? Right? Here's the law. Here's the law. It's always a yes, you owe taxes unless I give you one of the next 5 exceptions. Okay, here we go. Here we go. So, well, before I go there, a foreclosure trigger tax consequence, a short sale trigger tax consequence, a principal reduction in a loan mod trigger tax consequence, a deed in lieu of foreclosure trigger tax consequence. Let me talk about deed in lieu of foreclosure 1 second. Your homeowner says, forget the short sale. Let me do a lieu and deed foreclosure. What do you say? Well, let me just talk about that for 1 second, okay? Because a lot of realtors ask me, well, what about deed in lieu of foreclosure? Forget the short sale. Well, just listen to this, okay? All the laws that we talked about are geared towards short sale. The bank is not in a business to take back the house. Because when they take back the house, what are they going to do with it? They're going to rent it out? REO, what are they going to do with it? So short sale is the current flavor of our time, okay? So deed in lieu of foreclosure, it's out there, but it's not very much use. And that's what you should be telling your homeowner, because that's the truth. The bank is not in the business of taking the house back. They're in the business of cashing out or figuring out what to do with the loan. All right, so remember I said you always owe taxes unless I give you one of the next five exceptions. Here we go. The first exception is a purchase money, a non-recourse loan. And guys, write this down, okay? Because a lot of CPAs are going to blow your deal for you because they don't understand. They flatly don't understand. They flatly don't understand that if it's a purchase money, remember, purchase money is a non-recourse money. It's a ninja loan, remember? If it's a ninja loan, purchase money, non-recourse, I don't owe any taxes, okay? You got to know that, okay? And you should, every time a homeowner goes and check with their CPA comes back and says, you're going to owe taxes, tell the CPA, can you please research non-recourse loan? Okay, because non-recourse loan doesn't trigger any taxes. Okay? All right, you got to know that. And a purchase money non-recourse loan only applies to primary resident, 1 to 4 unit. Here's the key. You never refinance the money. So keep it very simple. I live here, I never refinanced. That's a purchase money. You can do your short sale until you're blue in the face. There's no tax consequences, okay? Okay? All right, let's move on. So if you, let's say for example, remember I said it was a non-recourse loan, there's no taxes, right? What if I refinance my home? I refinanced it, and let's say I took out $200,000, I took out $200,000, but I put the whole $200,000 back into fixing the house. Okay? So because I refinanced it, I took cash out, I put it back into the house, I cannot use the purchase money exception. Because remember I said that purchase money, you cannot touch it, right? You cannot refinance it, but I refinanced it. I took some money out and I put it back into the house. In that situation, you want to use this next law right here, the Mortgage Forgiveness Debt Relief Act. So, back up. I live here as my primary resident. I took $200,000 out to fix my house. Okay? My house looks better now. I do a short sale, no problem, because I have this law right here, the Mortgage Debt Relief Act. It's going to last for 1 more year. This year right here, President Obama is trying to extend it into 2015. We'll see what happens. Okay? But currently, the law of the land is no tax, IRS. Okay? You know what? So first law is primary resident. Second law is primary resident, refinance house, putting money back into the house. What if it's a rental property? If it's a rental property, you want to go to number 3. If it's a rental property, go to number 3, insolvency. Okay? Insolvency, will save you taxes. Insolvency is what I call the Kodak moment. Okay, I'm gonna, remember that, right? Kodak moment. I'm gonna take a picture of you at the close of escrow, and if you have more asset than liability, then you are insolvent. And to the extent that you're insolvent, you don't owe any taxes either. Okay? The fourth one is bankruptcy. If you do a bankruptcy, it wipes away the debt forgiveness part. Okay? The fifth one, if you do have any income, guys, if you do have any income, any gain, for example, and it's your primary resident, you would apply the capital gain rule of the no tax 250 to 500. You would use this mechanism. Okay, now, real quick, what determines a non-recourse loan, recourse loan? You look into state law. Go back to state law, okay? You look at your state law to see whether your loan is recourse or non-recourse, okay? Yes, so for non-recourse, well, let's just do it again. For non-recourse, look at state law. If it's a non-recourse loan, it's a purchase money loan. If it's a purchase money loan, no tax. Easy enough, okay? Let's move on. The debt forgiveness, we went through this already. Let's just do it real quick again. The Mortgage Debt Relief Act is your primary resident. You refinance your house. You took some money to fix the house. You apply this rule, okay? It's for your primary resident only. It doesn't apply to your rental property, second home, credit card debt, none of that stuff. Mortgage Debt Relief Act, strictly, purely, you put money back into the house. All right, and it's good for one more year, this year right here. President Obama is going to extend it. We don't know if it's going to get approved or not, so check on the law for 2014, 2015. All right, so like I said, check for the law. There's a proposal going on for 2015. Now, if you go to my website, paulhornlawfirm.com, or go to this website, there's a brochure you can give to your homeowner about tax. Okay? Now, primary resident. Primary resident for tax purposes is you live there 2 out of the last 5 years. You live there 2 out of the last 5 years, that's primary resident. Okay. Let's see. Now, the debt limit for a Mortgage Debt Relief Act is $2 million for federal. California is $800,000. All right? That's the maximum debt allowance. Insolvency, we talked about when you have a rental property, apply the insolvency rule. When you have a rental property, tell your CPA, please look at the insolvency rule. That's where it says no tax due to the extent you are insolvent. That's insolvency rule. All right. Okay, real quick. You did a great job in a short sale, and the homeowner got $30,000. The question is, does the homeowner pay cash for that, pay tax for that $30,000? Yep. Let me repeat. You did a great job on your short sale, and the homeowner gets $30,000. He's so happy. He goes to see a CPA. His CPA says you got to pay tax. I'm here to tell you the answer is no. Here's my position on it. Are you kidding me? Are you kidding me? I spent $150,000 in that house. I lost that house. My 30 grand back is a return of my capital. Okay? So go to see someone that knows what the heck they're talking about. Okay? Cash for key doesn't necessarily mean always tax. Do you follow that? I took 150 grand from my pocket to pay for this house. I only got 30 grand back. You want to pay taxes? No, it doesn't work like that, right? It's the same thing if you took out $15 to buy IBM stock and you sold it for $3 and you got $3 back. Do you pay taxes? No, you had a loss, right? Fair and simple, okay? Tenants, last subject. I'm sorry, I lie. Last subject. This will be fast. This will be fast. Just remember, let me just show you the complete slide. Just remember that if you represent an investor, and they buy a short sale, okay, and there's a tenant in there, the rule is this. If there's a tenant in the short sale and the foreclosure, if it's a month-to-month rent, you gotta give the tenant at least 90 days to move out. That's the minimum time is 90 days. Let's say if the tenant has a 90-year lease in there, and it's a real lease, your investor's stuck with it. Just keep aware of that. That's the California, that's the federal law. It's also the California Home Bill of Rights law, okay? I am coming to an end. Okay, I'm coming to an end. By the way, if you're on Facebook, add me as friend. Add me as friend on Facebook. I do a lot of updates and news, okay? It's Paul Horn, ESK, Gmail, or just go to my, it's Paul Horn Law. You'll find me there, okay?